Every 24 hours, Americans pay billions of dollars in interest, not to buy new homes, not to build businesses, but simply because they owe money. The average person works harder than ever. Technology has made workers more productive. Companies are earning record profits. Yet millions of people still feel like they're running on a treadmill that never stops. So here's the question. If modern society has become richer than ever before, why does it feel so difficult for ordinary people to get ahead? The answer isn't just debt. It's the system built around it. By the end of this video, you'll understand why debt has become one of the most profitable industries on Earth. We'll uncover how credit cards, mortgages, student loans, and even the money itself are connected in ways most people never notice. We'll look at the history that changed everything, the decisions made decades ago, and why millions of hardworking people unknowingly spend years transferring their wealth to someone else. Because once you understand how the system works, you'll never look at debt the same way again. On a Friday afternoon, Sarah walks into a grocery store. She fills her cart with food. Nothing extravagant. Eggs, milk, bread, a few things for dinner. At the checkout, she taps her credit card. The payment takes less than 2 seconds. She walks away without thinking about it. It feels effortless, convenient, almost invisible. But behind that tiny tap, a chain reaction begins. The bank expects repayment.
Interest begins accumulating if the balance isn't cleared. Payment processors collect fees. Credit bureaus update records. Investors who own debt-backed securities earn returns. A single purchase becomes part of a financial machine worth trillions of dollars. Sarah bought groceries. The system created an income stream. And Sarah isn't alone. Millions of people repeat this process every single day. But this raises a much bigger question. How did borrowing money become one of the largest businesses in human history? For most of history, borrowing money was rare. People saved before they spent. Loans were often reserved for emergencies, wars, or large business ventures. In many cultures, charging excessive interest was considered unethical. Some religions even prohibited it entirely. Debt carried a social cost. People wanted to avoid it. Then something changed. Banks became more sophisticated. Governments discovered that borrowing could fuel growth. Businesses realized customers bought far more when payment could be delayed. Instead of convincing people to spend less, the economy began rewarding people for spending tomorrow's money today. And that single shift transformed the modern world. But this was only the beginning. Because the biggest change wasn't that people borrowed more. It was that the entire economy slowly became dependent on it. For decades after World War II, the American economy experienced one of the greatest periods of prosperity in history. Wages were rising. Manufacturing was booming. A single income could often support an entire family. Buying a home didn't seem impossible. Saving money actually meant something. But by the 1970s, cracks began to appear. Inflation surged. Oil prices skyrocketed. Factories slowly moved overseas in search of cheaper labor. At the same time, wages for many workers began to stagnate. The cost of living, however, didn't get the memo. Housing became more expensive. Healthcare costs climbed. College tuition accelerated. Families faced a difficult choice: earn more or borrow more. For millions of Americans, borrowing became the only realistic option. But here's the twist. The financial industry didn't see this as a crisis. It saw an opportunity. Banks had discovered something incredibly powerful. A customer who pays cash creates one transaction. A customer who borrows creates years of revenue. Think about a 30-year mortgage. The house may be paid for on day one, but the loan can generate interest for decades. The same idea spread everywhere. credit cards, car loans, student loans, buy now, pay later. Each product made spending easier today while pushing the true cost into the future. Advertising reinforced the message. You deserve it. Don't wait. Pay over time. Debt stopped feeling like an emergency. It became normal. Then it became expected. Eventually, it became the foundation of everyday life. But there was another layer to the system that most people never saw. Where did banks get all this money to lend in the first place?
The answer surprises even many adults. Most people imagine a bank as a giant vault. Customers deposit money, the bank lends some of it out. Simple. But modern banking is far more complex. When a qualified borrower takes out a loan, new bank deposits can be created as part of the lending process under the banking system, subject to regulations and capital requirements. In other words, lending doesn't just move existing money around. It also expands the amount of money circulating through the economy. That's why debt and money are so closely connected. When borrowing increases, spending often increases too. Businesses sell more, asset prices can rise, economic growth speeds up. But there's a catch. Every loan comes with interest. And unlike the original loan amount, that interest still has to be earned by someone. Which means households work longer, businesses compete harder, and the economy constantly searches for more growth to service yesterday's debt. The system keeps moving until one question becomes impossible to ignore. What happens when people can no longer keep borrowing? Debt is rarely sold as debt. It's sold as freedom. Drive the car today. Own the home now. Get the degree first. Pay later. And in many cases, borrowing can be a useful tool. A mortgage can help a family buy a home. A business loan can help an entrepreneur grow. A student loan can open new opportunities. Debt itself isn't the villain. The problem begins when debt becomes the default solution to almost every financial challenge. When wages can't keep up with rising costs, borrowing fills the gap. At first, it feels manageable. Then, the monthly payments begin stacking up. One bill becomes three become five, and slowly, your future income is no longer yours. It's already promised to someone else. But if so many people are struggling, who's benefiting? Every month, millions of payments flow through the financial system. Mortgage payments, credit card interest, auto loans, personal loans. Each payment may seem small on its own, but together, they create one of the largest streams of cash in the global economy. Banks earn interest, investors who own debt-backed assets earn returns, payment networks collect fees. Financial institutions provide services that keep money moving through the economy. The more debt that is repaid over time, the more revenue many parts of the financial system can generate. That's why lending is such a powerful business.